Hi, this is Stacy Hyde, and I'm back with another episode of Better Financial Health in 15 minutes or less. And what I want to talk about today is ETFs. I'm not talking about EFT, which is an electronic funds transfer, which is generally how you get paid, direct deposit, that sort of thing. I'm talking about an ETF, an exchange traded fund. It's sort of like a mutual fund, but it's not. And it has some advantages. When they originally came out, ETFs were really index funds by another name, but they've grown in popularity mostly because their fees tend to be lower, they can trade throughout the day, and they tend to be more tax efficient because when someone sells shares of mutual funds, if the fund manager has to sell certain stocks that they either don't want to own anymore or they're having to sell it to meet redemptions because people are selling off the fund, then that's going to cause capital gains to be distributed out that year to the remaining shareholders. And so in this case, with an ETF, they can actually just distribute quote unquote shares of this stock, but it causes you will actually get cash. Because of that, it makes them much more tax efficient. But the thing that we want to talk about that you need to pay attention to with ETFs, because they all kind of look the same, but you might find some red flags in there. One of the things that you want to look at is, are they actually tracking the benchmark that they're set out to track? If it's an S&P 500, there's a lot of those. There's SPY, I think, is the longest running one, and it absolutely tracks the S&P 500. But then there's ones that are similar. DFUS, that's a dimensional fund, and it doesn't necessarily, each time the S&P 500 removes a stock, they don't have to do it on that same day because they're not an index fund. They're index similar. And so the tracking may be a little bit off, but oftentimes when an index has to sell or get rid of a stock because it no longer meets the criteria and add in the ones that do, as you can imagine, traders know that those index funds are going to have to buy that stock and they're going to be selling the other. So oftentimes, right around the time that that happens, the price of the one that's coming in is bid up, and the one that's going out is the price drops. And so you can benefit from that if you're working with a fund similar to Dimensional, because they don't necessarily have to do it on that day. They can actually be a liquidity provider in the market. So the other thing that you also see is some of these funds get into sort of very niche areas, and you can wind up taking more risk than what you thought. You can also wind up paying much higher fees for something that you could have gotten at a lower cost, which can also manifest itself in because ETFs are traded like a stock, so they trade throughout the day. So there's the what's called the NAV, the net asset value. What if you were to sell all of their individual holdings, what the fund would be worth per share versus what its market value is. So one of the things you want to pay attention to when choosing an ETF is their market price very close to their net asset value? Because that means that you're not going to have to worry about when you trade it. You also want to look at daily trading volume. Ones that don't trade often oftentimes have a big swing between what somebody's willing to pay you for it versus what you can buy it for. That's called the bid-ask spread. So you really want to make sure that you're looking through and paying attention and you're getting exactly what you want to have, and that it's tracking the index that you want to track if you're looking to track it exactly, or if you're looking to do some sort of factor investing, looking at dividend paying stocks or high profitability stocks, that you that their screen is actually getting you what you want, and that you're paying a reasonable fee for it, and that you're also looking at, is there enough trading volume in that fund that if you're buying and selling, you're getting a fair price, and that there's not a big swing between there's liquidity of the underlying investment, so there's not a big difference in the bid-ask spread. Because that's really what you want to make sure that you're taking advantage of there, because they can really benefit you. I know that capital gains taxes, if you hold them long term, are lower than ordinary income, but if you don't have to pay it, oftentimes that's great. Like we were looking at one fund that was in a client's account. It had just come to us. We had not purchased it, and they wanted to do some charitable giving, and so we targeted that fund for the charitable giving. It was nice, avoided capital gains on that, got full value for her charitable contribution. Plus, because we did it now before that fund went ex-dividend, meaning they were going to distribute capital gains, she avoided an 11.24% capital gains distribution on that fund. So if you're looking at investing this time of year, ETFs are also generally better because you don't get hit with capital gains distributions that you weren't even invested in when they were generated. So something else just to kind of keep in mind there. And just to review, ETF means exchange traded fund, similar to mutual funds, but not. And then there are also these things called exchange traded notes. We don't generally recommend those because that's a hybrid structure that's backed by some bank. I personally would much prefer to have an exchange traded fund. That way you know that you actually have shares in the underlying stocks. There's not another intermediary that may have an additional layer of fees in there as well. So to recap, pay attention to the index you're trying to track. Make sure that it makes sense for your investment philosophy and investment goals. Fees are reasonable, good volume, and the NAV and the market price are similar. Thanks again for tuning in. This has been another episode of Better Financial Health in 15 Minutes or Less.